What if I told you that Bitcoin may only be the foundation, but Ethereum could be the biggest financial trade of the next decade, and that a handful of crypto treasuries might actually outperform both?
Hello everyone, this is BTC Insight and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
Tom Lee begins with what's already clear. Bitcoin has earned its place as a core portfolio asset. Its size, stability, and track record as a censorship-resistant, fixed-supply store of value make it irreplaceable. Institutional investors have grown increasingly comfortable with Bitcoin. Many already understand how to model its value, and Bitcoin ETFs have opened the door for mainstream participation. But Lee reminds us that Bitcoin ETFs are only one piece of the puzzle. In fact, MicroStrategy, Michael Saylor's Bitcoin-focused company, has become an even larger vehicle for Bitcoin exposure than the biggest ETFs. Why? Because MicroStrategy doesn't just passively hold Bitcoin. It actively increases its holdings per share through a deliberate treasury strategy.
Bitcoin had a very clear place in someone's portfolio because of its not only proven size and stability, but it really is as a way to store value. And then when we thought about how people should allocate crypto outside of that, there were many projects, whether it was Solana, Sui, or the many things that you guys write about. But beginning this year, we started to take another hard look at Ethereum. And the reason for that is that I think that the regulatory picture is moving in a way this year in the United States in a favorable way that is getting Wall Street to take crypto and blockchain pretty seriously. And of course, the killer app or the ChatGPT moment really was stablecoins and Circle's IPO. But following on that was the Genius Act and then the SEC's Project Crypto. And the reason I think this favors Ethereum is many, but foremost, when we look at the projects that are taking place for Wall Street to tokenize assets, whether it's dollars or other assets, the majority of this is taking place on Ethereum. But maybe more importantly, I think people have to take a step back and realize that what's happening on Wall Street in 2025 is it's maybe more akin to what happened in 1971. And in 1971 was the year the US dollar depegged from gold. So the US went off the gold standard. And while gold was a beneficiary of that, many people bought gold, it was actually the idea that Wall Street began to innovate because suddenly you had a fiat dollar that you now had to sort of move around and create rails for that was not backed by gold. So the real winner there was Wall Street. Well, in 2025, this kind of innovation, blockchain solves a lot of problems and speeds a lot of things. Wall Street moving onto crypto rails, I think, is like a 1971 moment for Ethereum. So I think it's creating enormous opportunities to move a lot of things onto the blockchain. And Ethereum won't be just the only winner, but it's one of the primary winners. And from an institutional adoption perspective, I've heard a lot of people talk about this. Bitcoin's already become very institutional. When I talk to investors and I do meetings, they understand how to sort of understand how to model or even think about future value for Bitcoin. And it is in a lot of people's portfolios. Ethereum is so underowned that it's more like Bitcoin in 2017. I don't think Ethereum is actually viewed as an institutional asset today. So I think it's so early. And that's why I think there's a bigger opportunity. The value of Ethereum as both a payment rails, okay, and then capturing a portion of payment volumes. And so I think both are kind of additive concepts. And so their idea is that if you look at the addressable market for what it takes place on the banking system and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, okay, which is about $450 billion a year, and assume, there's a gas fee per transaction. and then what it means to essentially network revenue, you apply, I think, a conservative 30 multiple to that, you get roughly $3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000 per unit. And again, that's that's an 18x roughly from here. Bitcoin ETFs give you direct exposure to Bitcoin. But if you look at the Bitcoin treasury space, MicroStrategy is larger than the largest Bitcoin ETF. So there's actually more investors who are preferring to own Bitcoin through MicroStrategy than through Bitcoin. And I think it's for a logical reason, which is that a crypto treasury isn't just giving you a static exposure to Ethereum. What they're doing is they are giving you exposure to someone who is trying to grow your Ethereum holdings per share. And MicroStrategy is a great example. When they went to pivot to their Bitcoin strategy in August 2020, MicroStrategy had roughly a $13 stock price, and it's gone to 400, well, let's say 30x from that point in the last 5 years. During that time, Bitcoin was 11,000, and now it's about 120,000. So it's about an 11x. That means that MicroStrategy has grown its holdings of Bitcoin per share, while like a Bitcoin ETF would have kept you constant. So in that same 5-year period, you'd made 11x owning a Bitcoin ETF, but you did far better because of his treasury strategy. And that treasury strategy is using and taking advantage of the liquidity of his stock and the volatility of his stock so that he can acquire more Bitcoin per share. And that's what Michael Saylor's strategy has successfully done, because he went from having, $1 or $2 of Bitcoin per share to 227 today. So a massive, massive increase.
The third major theme in Tom Lee's analysis is the rise of crypto treasury companies. These are firms that hold Bitcoin or Ethereum on their balance sheets, not simply to track prices, but to grow holdings over time. MicroStrategy proved this model with Bitcoin, but Lee highlights how Ethereum treasuries could become even more powerful. That's because Ethereum not only appreciates in value, but also generates staking yield, something ETFs can't fully replicate due to liquidity restrictions. Take BitMine as an example. Within weeks of pivoting to an Ethereum treasury, it grew its ETH per share more than 6-fold. That growth isn't just about price. It's about execution, liquidity, and velocity, or how quickly a company can increase its crypto holdings per share.
Two kinds of EPS. There's both Ethereum per share, but as you know, the Ethereum treasuries actually are going to generate staking yield. And so, if you look at something like BitMine's current holdings, I'm just going to grab my calculator real quick. And it was disclosed, the one disclosed last week, it's almost $200 million of GAAP net income. So there is actually EPS. There's like an earnings per share, and then there'll be ETH per share. One will have to be like in quotes, EPS. Many investors who've owned MicroStrategy have done really well with it, but MicroStrategy is not as widely owned as you think, even though it is one of the largest stocks in the market today. And the reason many people don't understand it is that we already have a very big universe of people that don't believe in crypto. I mean, whether you look at any survey, the Bank of America's latest survey, 75% of institutional investors have zero exposure to crypto. Zero. So that's 3/4 of the universe. And when they look at crypto treasuries, they think that these are inferior to holding the underlying token. And so a lot of the education that we've done in our meetings is to explain that, and I can just cite some numbers from BitMine's presentation. The difference in a crypto treasury versus holding Ethereum is simply the fact that we are growing your Ethereum holdings per share, because on July 8th, when we closed the pivot to the Ethereum treasury, there was only $4 of Ethereum held per share. And then on July 27th, which is about a month ago, when we published that update and put it in a presentation, there was $23 of Ethereum per share. So the amount of ETH held per share went up by like 6 times. And, or sorry, 8 times, 9 times. And so it really shows you that there is a really big change in how much, what I call the velocity or the accretion held of ETH per share that comes from a properly executed treasury strategy. Any treasury company should study what MicroStrategy did, because Michael Saylor, by the way, he was not the first Bitcoin treasury company. The first one was Overstock, if you guys remember. And, and they had Bitcoin on their balance sheet. But that was, did not resonate with investors, and it didn't ever really help the stock. And then Michael Saylor came along and did it in a much, much more deliberate and big way. And so I think that that's really served us. And so what we realized was that in order to really execute a crypto treasury strategy properly, you need to really, as a first principle, just have a super clean strategy. And that's what BitMine's pursued, doing it only with basically common equity. So not doing any derivative structures. And because then it really makes it really easy and clean for investors to understand what the company's pursuing. Down the road, of course, it will appeal to maybe add other strategies that take advantage of either volatility or the market cap size. But I think that the key is really for the company to clearly articulate a strategy that connects with shareholders. That is really important, because that is why Palantir has earned the premium it has. It's, of course, a great product, but it's really because shareholders feel like they're owning something important. And so I think foremost is really for investors to understand that Ethereum is one of the biggest macro trades out there for the next 10, 15 years. And I think compared to other Ethereum treasuries, everyone should benefit, as Ethereum rises. But I think that the price that a company trades at as a multiple of its Ethereum holdings isn't just reflecting the ETH held like that, because that's worth 1.0. The staking yield is getting a premium, because if you're getting 3% yield, if you earn 3% yield, but you put a 20 multiple on it, maybe you should put a 30 multiple on it because there's no cost. That should be 0.9. So I think an Ethereum treasury should trade at 1.9. And remember, Ethereum ETFs cannot fully stake because of liquidity requirements. So they will never get the proper multiple for their staking. And then everything beyond that should be a function of the liquidity of a company's stock and the velocity, because the liquidity is how much you trade, because that's your ability to tap capital markets. And if your stock is thinly traded, you can't really raise money or do any future transactions taking, converts and preferreds. And then the last, of course, is the velocity. How quickly are you able to add Ethereum per share? That is what people should start to apply a multiple for, and they're not today. I think people are being overly simplistic when they look at just price to NAV, which is, of course, a useful metric. It's like price to book. But imagine if someone said, like, here's a company where the earnings are growing 100% a year, and here's one growing at 0, but we'll put the same price to book multiple on it. We can't, but that's what people do today when they force fit. And I think that's why like a MetaPlanet should trade at a premium, because they're able to raise money.
Tom Lee's conclusion is simple but powerful. Ethereum may be one of the biggest macro trades of the next 10 to 15 years. Bitcoin provides the base, but Ethereum offers exponential upside as financial infrastructure shifts onto blockchain rails. And for investors, crypto treasuries could be the secret weapon, combining asset appreciation, staking yield, and treasury strategies that magnify returns per share.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.